Hey everyone, Couch Investor here with another video for you today. In today's video is going to be about value investing and investing in general, my opinion on the matter. I know there are a lot of videos out there that cover that, but I guess some of you might want to know my own opinion and the way I invest in the stock market. By the way, Sunday's video is going to be about lemonade because most of you voted for that. So if you have any specific questions or topics you want me to cover, let me know down in the comments below or go check out the new community tab. And before I get into this video, if you haven't subscribed yet, help me grow the channel by hitting that subscribe button. And if you like the videos, maybe leave it an early thumbs up as well, as it really helps me out grow the channel. So without further ado, let's dive into this. Right, so first let's start reading the definition of value investing. So value investing is an investment strategy that involves picking stocks that appear to be trading for less than their intrinsic value or book value. Value investors actively seek out stocks they think the stock market is underestimating or underappreciating. An example of a value stock is a bank stock, or most bank stocks are considered to be value stocks. Let's take an example, Citigroup. Citigroup's PE ratio is around 9, whereas the average S&P 500 company lies at around about 19. So as you can see, the market is underestimating its potential, underappreciating the company, and that's why it's a value stock, because it might be undervalued. Also, most value stocks, in this case most bank stocks, pay a nice dividend yield, so that's also an added value, but we're going to talk about dividend stocks a bit later. So here's my question. Is it still worth it to buy value stock? Is it not worth it to buy growth stocks? What's the difference between the two of them? We're going to go over that in a bit. So let's first define growth stocks. So a growth stock is any share in a company that is anticipated to grow at a rate significantly above the average growth for the market. These stocks generally do not pay dividends. A couple of examples of growth stocks is Apple. Obviously, Apple pays dividends, but is still considered to be a growth stock. Amazon, Tesla, Square are all growth stocks because they are expected to beat the market. All right, so let's start with the first picture right here. We can see that value investing was a winning strategy early on, but as soon as technology came into play, that's my opinion, that changed. Disregards obviously the dot-com bubble because that doesn't count. But even with that big of an advantage early on, we can see that growth stocks have actually outperformed value stocks over the long term. If you had invested $100 in value stocks in 1926, I doubt you had, but you would have made over $10 million right now. If you would have invested in value stocks back then, you would have made about $500,000, which is still a nice amount of money, but if you compare both of them, obviously you would have liked to invest in growth stock. Now here's another example. We're going to compare the Russell Growth Index and the Russell Value Index. So over a 10-year time period, we can see that the Growth Index has outperformed the Value one with over 140%. As you can see, the Growth Index is at plus 365%. The Value one is at plus 221%. Those are crazy numbers, right? So how did Warren Buffett become so wealthy? Because Warren Buffett, as we all know, he's the type of investor that has invested in value stocks from day one and obviously has added Apple to his portfolio a couple of years ago. So how did he do it? Well, for one, he did not invest only $100. He probably invested way more than that. The graph was just a hypothetical graph, so we can just get a better picture on the matter. And two, there's something called compound interest, something that will grow your portfolio. The longer you hold the stock, the better and the bigger the rewards will be. So here we're coming back to the topic of dividend stocks. So here again, let's talk about Warren Buffett. Warren Buffett actually bought $1 billion worth of Coca-Cola stocks back in 1988. At the time of making this video, you can see right here that Warren Buffett, or let's say Berkshire Hathaway, owns 400 million shares of Coke. That's about $460 million worth of dividend payments every year after taxes. That's approximately my calculations. If you look at this, then obviously value investing and investing in dividend stocks works very well, but you will need $1 billion to be making that much money. Actually, you don't really need $1 billion, but you get the point. You will need a lot of money to actually earn a lot of dividends. And here's my take actually on dividend stocks. The fact that a company wants to reward its shareholders by paying them a dividend payment should not affect your decision on whether or not you will be willing to invest in the company. A dividend is just a bonus you are getting as a shareholder. For some companies, I would rather the company keep the dividend payments and reinvest it in new products, maybe new developments, etc. So eventually I will maybe gain from that even more by just the share price going up. Because most people that are beginners in investing probably won't have hundreds of thousands of dollars to invest in dividend stocks. So you would eventually make maybe what, $10, $20 pre-tax on dividend payments, which isn't really helpful if you want to get there to the highest wealth potential from investing. But even Warren Buffett's technique isn't working. We all know that this year Warren Buffett and Berkshire took a major hit. They actually sold all of their airline stocks, but that's not all. As we can see here, only 4 corporations have had a worse year-to-date performance than Berkshire. We can see JP Morgan, Wells Fargo, Bank of America, ExxonMobil. All of them are bank stocks and one ugly oil company. Compare that to growth stocks this year, Warren Buffett has a lot of catching up to do. So what am I actually doing? Because most of you know I already covered stocks like Coca-Cola and Starbucks. Look, I like those companies, I invested in those companies, but do I actually think that those companies are going to make me wealthy in the long run? Probably not. Stocks like Tesla and Square, those are the types of companies that will probably boost my portfolio in the next 5 to 10 years. So what am I doing and what do I think most of you should do as well is something called dollar cost averaging. Now, dollar cost averaging is perfect for people that keep on hesitating before they're buying a stock. When should I buy a stock? Will it go higher? Will it go lower? What should I do? You should just dollar cost average. I don't know what's going to happen in the short term with the stock, but I know that when I invest in a company such as Tesla or Square or Lemonade, for example, I know that eventually the stock will go higher because the company will be successful. And when a company is successful, the stock usually goes higher and higher, and investors and shareholders are very happy. So by dollar cost averaging, meaning if you put, let's say, $100, $500, $1,000 each month, or in an index fund, or in a couple of stocks, that's how you get a good entry point into a stock, and you don't have to panic or ask yourself every time, should I invest now? Should I invest later? Buy orders are also a very good thing to set up. For example, with Lemonade, I have a couple of buy orders. Since it's an early IPO stage, I believe the stock will be volatile in the short term, so I've put a couple of buy orders on the stock. But let's look at a couple of charts right here. So as we can see, there's another way of thinking, and that's buying the dip. Now, as we can see, there's a comparison between dollar cost averaging versus buying the dip. So for example, for buying the dip, like in March, I bought more Square stocks. So obviously my entry point price will be much lower right now. So why wouldn't I buy each dip? Well, for a starter, so why wouldn't I wait for a dip and invest every time there's a dip? Well, to start with, I don't know when a stock will fall, when there will be a dip, when there will be an outbreak, a pandemic, a war, trade war, etc. So by dollar cost averaging, you do not have to wait for dips to invest in a stock. So as we can see here on the first picture, buying the dip did not outperform dollar cost averaging, because the sooner you get into a stock, the more time you hold the stock, and that's when compound interest starts working. We can see here on the other picture, I know a lot of you will probably raise this question. We can see on the picture right here that buying the dip actually outperformed dollar cost averaging. So how is that possible? Well, very simple. If you have a lot of money and a dip occurs, such as a dip in March, instead of putting your usual $500 or $100 each month in this specific stock, when there's a huge dip, you suddenly decide to put $2,000 in the stock. Then obviously you are already a couple of months ahead of schedule, and that's why in this graph we just seen, buying the dip has outperformed dollar cost averaging. But in the long run, dollar cost averaging will always outperform any strategy. Here's the last two things I want to add before I end this video. So if you're actually really interested in investing in the stock market or investing in general and want to make money in the long run by investing, here's a quote for you from Fight Club. So we buy things we don't need with money we don't have to impress people we don't like. So this is what I have to say to every beginner investor. Stop spending on useless and start investing in yourself. Stop buying things you don't need and start buying shares from a company that will probably help you become wealthier in the future. Lastly, do the extra research. I've seen a lot of YouTubers here covering stocks without doing any research on them. They just show some graphs, show some articles, don't talk about what the company is actually doing, what the future plans of the companies are, the numbers the companies are showing us. You don't have to believe me every time I tell you buy Disney stock, buy Square, buy Tesla. Go do your extra research, and if you agree with me, then fine. But don't blindly follow people just because they tell you to buy in a specific stock. For example, Peter Lynch, when he started investing in Dunkin Donuts, he actually went to Dunkin Donuts into the store and asked people if they liked the coffee, if they liked the donuts. That's just one of the ways to do some research. Other ways are look at the financial reports, look at some interviews from the founders. You can learn a lot about just listening to a founder talk about the company he's running. That's what I'm doing. That's what I did with Lemonade, and that's what I will show you on Sunday as well. And that's about it. That's how I go around my investment strategy. I hope this was insightful. If you like this type of videos, let me know down in the comments below. Maybe I'll do some more of those. And like always, guys, take care, stay safe, and see you all in the next video. Bye bye.